A follower recently asked, are there any adjustments I should make now to minimize the risk of a recession in 2025? I'm trying to decide whether to shift my investments out of stocks in case the market goes down. And after working with hundreds of wealthy individuals and families over the years, I can tell you one thing for sure. No one, and I mean not one person, has told me that they got rich by perfectly timing recessions. The wealthiest investors aren't some kind of fortune tellers. They're strategic planners who understand one fundamental truth, and that is economic uncertainty is not a flashing red stop sign. It's just an invitation to prepare, and I'm going to show you a few ways how. But first, if I haven't met you yet, I'm Will, and I own a retirement planning firm called Pursuit Street Advisors. And we help individuals and families reduce taxes, invest smarter, and retire better. So if you want to hear more about how we do it, hit the subscribe button. Since 1950, the United States has experienced 11 recessions. On average, that's one about every 7 years or so. Sounds fairly predictable, right? But in reality, the stock market is anything but average. In the 80s, we had 2 recessions in just 3 years. Through the 2010s, we didn't even have one for an entire decade. And remember in 2022 when everyone was certain that a recession was imminent? Well, spoiler alert, it never happened. Let's face it, very few people saw the 2008 financial crisis coming, and even fewer got it right afterwards. The people who called the crash have been in the media predicting doom and gloom ever since, and they've been wrong every time. Regardless of what causes the next recession, I have very little faith in anyone's ability to accurately predict the market in advance. The problem is that most investors do the exact wrong thing when they hear recession is coming. They panic, they sell, and they try and time the market. Here's the hard truth. Trying to predict economic downturns is like trying to predict winning lottery numbers. Nearly impossible. So if you're in your 50s today and you're fortunate enough to have another 30 to 40 years left, statistically speaking, you'll likely experience maybe 8 to 10 plus bear markets, 2 to 3 massive market crashes, and maybe even 5 to 6 full economic recessions. Maybe more, maybe less. But the odds of perfectly predicting every single one of those, 0.0%. Even if you do correctly predict one of these events, what next? When do you get back in the market? So when you think about it from that perspective, the odds of being right are even lower because you need to be right 2 times. When you get out and also when you get back in. And what happens if you're wrong? So what do all those wealthy investors know that you don't? In reality, it really just comes down to 3 words: strategic long-term planning. And instead of trying to dodge every economic bullet, so to speak, you need to just build an investment framework that'll stand up to the various seasons of the market. And I'm going to give you 3 important things to think about as you're doing your own strategic planning. So, number 1, asset allocation is the key. It's possibly the most important investment decision you'll make, and it's the driving factor behind over 90% of investment returns. And asset allocation just refers to how you distribute your investments across different categories, primarily stocks, bonds, real estate, cash equivalents, stuff like that. And the goal is to balance risk and reward according to your specific circumstances, time horizon, and financial goals. So for retirement-focused investors, proper asset allocation serves several important functions. It provides risk management through diversification, or more simply, not putting all your eggs into one basket, which helps spread risk across multiple asset classes. It also enables tax-efficient investing, and strategic placement of investments across account types can increase after-tax returns without adding additional risk into the equation, which can be just as important as the selection of the assets themselves. And that's going to be placing tax-inefficient investments think like bonds, REITs, and active funds, in tax-advantaged accounts, and hold tax-efficient investments, think like muni bonds, index funds, individual stocks, in taxable accounts. Then positioning your high growth assets with the greatest appreciation potential in your Roth or tax-free accounts. And it creates sustainable income while preserving growth potential, because rather than fixed withdrawal hierarchies, implementing adaptive strategies, meaning instead of using rules of thumb like drawing down the taxable accounts first, tax deferred second, and tax-free last, base your withdrawals on current and projected tax brackets, as well as Roth conversion strategies, because this might influence which accounts you'll draw from in a given year. And market conditions and relative valuations could also suggest trimming positions that have increased a lot in value for income. And also don't forget about required minimum distribution obligations that'll create forced withdrawal situations that need to be considered in the overall strategy. And charitable intent and legacy planning objectives can also influence which assets are preserved for wealth transfer and which are optimized for lifetime spending. And the most important thing to understand about asset allocation is that it needs to be personalized to your unique situation. General formulas and rules of thumb can provide useful starting points, but they can't really account for the complexity of your individual financial circumstances. So if you want a little deeper dive on asset allocation, I'll link our article down below. Second, perspective is everything. Adopting a long-term perspective does more than improve returns. It'll transform your relationship with investing. And this means stop looking at your portfolio like a day trader would, living in stress and uncertainty over every tiny market move. The stock market isn't just a place to park money. It's a mechanism that transfers wealth from the impatient to the patient. And building wealth in the stock market is a multi-decade process, not some get-rich-quick scheme. And even in years with positive returns, the S&P 500 has historically seen an average intra-year decline of 14% or so, which just highlights how much risk short-term investing can carry. However, since 1926, there hasn't been a single 20-year period where the stock market failed to generate a positive return. So in other words, stocks have been positive 100% of the time over any 20-year period since 1926. Playing the long game still remains undefeated. And finally, rebalancing is your secret weapon. Do annual portfolio reviews and adjust allocations based on performance. And if you haven't rebalanced recently, you're likely overweight in stocks after a few good years in a row. So taking profits from higher performing assets and reinvesting strategically into underperforming or more stable assets essentially forces you to buy low and sell high. It removes the emotion from the decision-making process, forcing more disciplined selling of winners and buying of laggards. And rebalancing just forces you to be contrarian in a systematic way. And this disciplined approach of buying low and selling high might not be exciting, but it's one of the few reliable edges available to individual investors in an unpredictable market. I don't know when or why, but another recession is inevitable. So instead of trying to predict it, focus on being prepared. Stay appropriately diversified. Keep a long-term perspective. Rebalance regularly, and keep enough liquid savings in your financial war chest to weather any storms. And the smartest approach when planning over your lifetime, regardless of what the economy is doing, is to have an asset allocation that aligns, but also changes with your risk tolerance and time horizon as they change. And the fundamental principle here is that your asset allocation should serve your life goals, not the other way around. By customizing your asset allocation to your specific needs, you can develop an approach that truly supports your vision for retirement. Rather than relying on oversimplified rules of thumb, a more sophisticated approach considers how your allocation should evolve throughout your financial life cycle, with particular attention to tax implications and the changing risk profiles over the years. So if you're looking to build a bulletproof investment strategy, we offer a free retirement analysis for qualified individuals and families. Click the link in the description to get personalized answers to your biggest retirement questions. And remember to hit that subscribe button and drop me a comment below. I want to know, what's your biggest fear about investing during uncertain times?